if we do not blow the system up in the next 12 to 18 months, which is to say, if we don't have a real crisis in confidence that's at least temporarily bigger than the Fed's and the big thinkers' ability to stick handle our way out of, the ultimate response, I suspect, will be good old-fashioned 1970s style stagflation. Not a pretty circumstance.
Welcome back to Liberty and Finance and Reluctant Preppers. We have a returning guest that is highly anticipated always by our viewers. Rick Rule is the CEO of Sprott Asset Management. He joins us again from his office, this time in Carlsbad, California, rather than his home self-quarantine where we had him last time. Rick, thanks for joining us again.
Always a pleasure to be on with you, Dunnigan. I enjoy these sessions.
Today's date, I should mention, everyone, is Wednesday, April 29, 2020, and we have a lot of questions that have been submitted prior to your arrival. But first, if we could give you a couple minutes to bring us up to date on what things you're watching as major trends. We've certainly seen tremendous volatility over the past quarter, both in the equity markets, debt market, precious metals. And if you could bring us up to date, not to mention world economic stoppage almost, and huge curtailment of people's liberties, and now the beginnings of perhaps a springtime, we'll see. So what are you watching that people should be aware of, and to help them be aware and prepared for what's coming next?
Well, Dunnigan, the circumstance that I see is almost surreal. In my youth, I would have described it as psychedelic, and perhaps accused myself of taking the wrong pill.
Wrong mushrooms, yeah.
When you look out at the circumstance, as an example, there's no other excuse for it. I watched the Fed walk into the high yield or junk bond market last week. The market was no bid. And suddenly a buyer appeared and took the junk bond market up 10 or 12%. Absolutely surreal. That's you and I buying substandard securities to restore confidence in the market. Obviously, clearly a distortion. That's really all I need to say. I'm watching in the very near term the wind go out of the sails of gold purchasers and gold stocks, which is frankly welcome and helpful to me. I'd like to acquire many, many, many more of them, and I'd like to pay less for them rather than more. So the fact that they're in near-term decline, from my viewpoint, is something called a sale. It's also helpful in a bull market to understand that a bull market doesn't have straight stair steps to heaven and backs and fills. That's the nature of these sorts of things. It's an extremely healthy sign, both for the market and also for myself, who is looking to buy more of these stocks for himself and for his clients. I look with interest, of course, at all the circumstances around the COVID-19 virus. I don't have any comments on it. I may be the only one in the world who doesn't have a comment on it, but the truth is I'm not a virologist or an epidemiologist. There are subjects that I think I'm capable of commenting on, but this isn't one. I am, however, comfortable commenting on the economic impact of the crisis and the policy response. The circumstance that we have where economic activity is really grinding to a halt all over the place, I don't think has been correctly reflected in equities markets.
Right.
I also don't believe that the possible impact of credit markets, the ramifications in credit markets, has been reflected in equities markets. If people aren't paying their rents, if people aren't paying their mortgages, this will be difficult for, as an example, the banking community, the bond community, the junk debt community. And there may be limits to the market's confidence with regards to quantitative easing, which we've described in prior conversations, in fact, as counterfeiting. I'm not saying that there's going to be a pin that's going to pop the general equities balloon or the bond balloon. All I'm saying is that the thing that's propping these markets up right now is artificial liquidity and artificially low interest rates. And if the Fed isn't capable of maintaining the markets and, more importantly, probably maintaining artificial confidence in these markets, you could see another leg down. If you don't see another leg down, what you're going to see is insane volatility. The volatility that comes from the market's confidence being bolstered by the Fed at the same time that it's challenged by the economy. Volatility usually occurs in the face of very, very, very conflicting forces. And this is the best conjunction of conflicting forces that I've seen in a 45-year career in securities markets. Truly interesting times. I understand that that's a curse. May you live in interesting times, but you do. So you may as well take advantage of it. The upshot of all this, before we get to your questions, really three things. Maintain lots of cash liquidity. I know that the purchasing power of your U.S. dollars and your U.S. dollar savings is declining, which is to say, I know that your dollar is going to be worth less next year than this year and worth less than that the year after. That notwithstanding, maintain some U.S. dollar liquidity because it will give you the cash and the courage to take advantage of volatility rather than being taken psychological advantage of by volatility. It's important to know that you must maintain cash even though that cash is losing its purchasing power. Maintain, too, bullion. Bullion is very good cash. It doesn't need to be all your cash, but it's highly liquid. And it is the type of cash that functions both as cash and as insurance. If the circumstance that we're in really causes people to question the savings in U.S. dollar denominated savings products like certificates of deposits or treasuries, the response of gold and silver to the upside could, I'm not saying will, I'm saying could be dramatic. Particularly, Dunnigan, for those listeners of yours who are maybe my age or older and have been taught by their conventional financial planner to have the percentage of their portfolio that corresponds with their age in bonds. This was a popular financial planning.
Standard advice. Yep.
Years ago, that would suggest that I have 67% of my portfolios in bonds. Ain't no way. But that notwithstanding, for people who have done that, you need to increase your gold allocation because the thing that goes wrong with a gold portfolio is depreciation of the currency. Finally, so we said hold some U.S. dollar cash, hold some gold, good cash. And for the rest of your money, invest in things that you're prepared to study and you're prepared to know about. The benign climate that we've existed in for the last 30 years, where you could have a hunch and bet a bunch, I think is over. I think you're going to need to be careful in terms of both bond and equity investments, probably for the next 5 or 6 years. So yes, invest, absolutely. But know more about what you're investing in. Have a reason to own something so that you won't be shaken out by volatility. I think it's important that you do those 3 steps.
There's a question related to what you've been describing by a viewer named Shaw who says, "Hi, Rick. What is a good hedge for your cash when you already have gold positions in both equity and physical, but still have over the limit of insured 100K or 250K, depending on where you are in each bank account? Physical cash or any other place to put them?"
I don't advocate physical cash for the same reason that I don't advocate storing physical gold at home. You sometimes run the risk of unwanted visitors. My belief is that if you are concerned about the FDIC limit at a certain bank, that you investigate doing business with multiple banks. 2 that I could recommend, I'm not affiliated with either of them except as a shareholder, would be Farmers and Merchants Bank of Long Beach, an old-fashioned bank that has cash in it, which I find to be a very safe bank as a depositor. And also a little tiny bank out in Hemet, California called Bank of Hemet, another one where equity is 13% of primary assets. It's odd to me that the FDIC will tell you that 7% of assets should be represented by equity. That means that these banks are being run with over 90% leverage, which assumes, which is probably true, that the people who run those banks are substantially smarter than I, but I suspect they might not be that smart in this period of time. The other thing that one can do, although I would argue that it's unpatriotic, is store some of your cash in very short-term treasuries or in ETFs, non-leveraged ETFs that are geared to short-term treasuries. Yes, the yields are paltry. Yes, that's a cross that you have to bear.
So that probably puts perspective on this next question from Josh G., who says, Rick, do you think there is any saving this country and the world from a complete economic collapse, or is it just a waiting game at this point?
I absolutely believe that we can get out of this circumstance if we could convince ourselves to do less. The problem is that we elect all these big thinkers to give us more of the disease as some path to the cure.
The debt being the drug, yes.
Yeah, and these benefits. I mean, we basically elect all these big thinkers to steal from our neighbors and protect us from our neighbors. We just need to stop stealing, stop spending. This is still the most innovative country on the planet. This is still a place where 6 pimply-faced kids take over a garage in Sunnyvale and out pops Google. I mean, the truth is, if we could constrain our ask from government, I know that's a big ask, and get back to doing what we used to do, which is to say, serve our customers, innovate, earn, save, invest, we would bury this problem, and we would bury this problem much quicker than you believe. Will we do that? That's a very different question. What I would ask your viewers is that you focus on saving yourself. I realize that society and the country is important, but the way that you strengthen society is to strengthen yourself. If more individual families were anti-fragile, if more individual families lived within their means and saved and invested, we wouldn't have a social problem.
You know, it's quite concerning that when we were describing sort of the fiber and the roots of our culture, both from a building, creating, innovating, saving, that sort of thing. There's been a huge generational shift here, and with recently, I've just been seeing, on the news feeds popping up these ads where you have the very sympathetic photo of a young person. It's always a young person saying, we're not getting what we deserve from the government, and frankly, there's always a kernel of truth in anything that's going to be effective at getting under your skin, and that's that thing that if the bigwigs are getting trillions or billions, don't I deserve my check on a recurring basis? So how do you turn on that temptation, turn away from that temptation to go, okay, maybe the bigwigs are getting their stuff, but I'm going to do what Rick just described, of pull myself up by my bootstraps, create value, see a need, fill a need, that kind of thing. What's your thought process that gets your head back on straight about that when you're getting, the siren song calling you to abandon all hope and go for the dole?
4 comments. The first is that relying on the political elites to save you makes you fragile. The only one for sure who cares about you is you. You might not like the sound of that, but that doesn't matter. It's true. It is also true that elections are advanced auctions of stolen property. Everybody needs to understand that. And some of the discomfort that the younger generation feels is real. Quantitative easing is a way to forward shift benefits to old folks like me and backshift the cost to younger people. If the younger people feel like they're getting screwed, it's because the younger people are getting screwed. There are $100 trillion in off-balance sheet liabilities in this country. An off-balance sheet liability is benefits that my generation voted itself as being paid for by younger people. So if they feel aggrieved, it's because they are aggrieved. The idea that they would trust the beast that caused the burden to fall upon them to relieve them of the burden, I would suggest to you is somewhat naive. I would also say, however, that I feel extremely heartened by the young generation. While it is true what you say, that there are many, many young people who believe in the sort of AOC dictum that they are owed, it is also true that there are 160,000 members of Students for Liberty now, a student libertarian organization. When I was a student, albeit figuratively in the Paleolithic era, there were probably 5 students who could spell libertarian. And the idea that in 50 years, the march of the understanding of freedom has been so dramatic gives me tremendous hope. Finally, I would say to you that the vilification of the 1% is insane. Everyone should aspire to be part of the 1%. The fact, for the most part, that people became wealthy suggests that through their efforts they provided goods and services to other people who other people willingly bought. And the fact that they have become rich is adequate testimony that they have already fulfilled their service to society. Otherwise, they wouldn't have made all the money. Profits are the excess of utility generated over utility concerned. Now, I agree completely with the statement that the rich should pay their fair share. In truth, the 1% in the United States pays 42% of tax revenues. And I believe that the rich should get a rebate. I believe that they should pay their fair share. I don't believe they should pay 42%. I believe they should pay much less. But of course, that's not a very popular view.
One of the things you mentioned along the way there, I wonder, you said there were much fewer people identifying themselves as libertarians, back in the Paleolithic era than there are today. But I wonder how much more that's because you didn't need a term to describe what it was to be an American.
Well, at that point in time, I must say, and it's continued to today, the people identified as Democrats or Republicans, and the Republican ethos was very much free market. But the Republicans, to be completely honest, and your Republican viewers will hate me for this, still believed in government. They still believed in stealing other people's wealth. They just did it for a different constituency than the Democrats.
Right.
I do remember that, as an example, in school, they taught something called the Bill of Rights. Now, it was odd that during the period of time that I grew up, I suspect that citizens knew more and cared more about the Bill of Rights than our elected representatives did and do. Certainly, the precepts of the American myth are wonderful precepts. My suggestion to you is that, at least in terms of our political society, that those precepts have been forgotten.
Certainly no longer forming the framework that's actually being acted on and enacted. We can see more and more evidence of that every day. We have a question from Linda Adrid who says, I'm very thankful for your interviews and voice of reason in this crazy time. Recently heard you say you might be a seller of precious metals in around 18 months. Most gold people are so bullish and calling for gold upwards of $10,000. Are you seeing something different for the future of precious metals?
I'm not. What I know about precious metals, and I love this question, what I know about precious metals, particularly physical precious metals, particularly gold, is that it fulfills an insurance function. And when the set of circumstances occurs, or if the set of circumstances occurs, that causes many people, not just the few like ourselves, to be concerned about the maintenance of purchasing power in other forms of savings, like U.S. Treasury bonds, the up move in gold that accompanies that crisis of confidence is dramatic. And ironically, when gold has moved enough that the insurance it offers becomes expensive rather than cheap, which is to say that when the price action of gold justifies in people's minds the narrative, and the price of gold doesn't need to go up anymore, it goes up dramatically. And when that circumstance occurs, and I don't know what price that will be at, but when the price of a basket of other asset classes that I'm attracted to, say pipelines, which yield an old man like me income, or agricultural land, or a basket of other commodities, becomes extraordinarily cheap in gold terms, I will begin to exit the gold trade and use the savings that I have maintained in gold to purchase asset classes that I consider to be more appropriate at the time. What I said in terms of 18 months is I gave that number in response to a question that asked whether after a 15% move in gold, that the move was over, whether somebody had missed the wagon. And because gold stocks were up, had they missed the wagon? And the answer, which somebody expropriated for a headline, was that if you look on the Barron's Gold Mining Chart Index that we've talked so often about in your interviews, the average of 8 prior recoveries from oversold bottoms varied in duration between 13 months and 42 months. And my suspicion is that we won't have worn out our welcome in the gold trade for at least 18 months.
Okay.
That wordy explanation didn't make a great headline.
Yep, you got it though. Okay. And that's it's interesting because another thing you just covered there was this sort of these phases. You've told us in the past you're a credit analyst, you're a value analyst, you're not a psychologist or a forecaster, but you did talk about sort of these phases where you said there's the time when gold was underappreciated, and then people start to, those who especially are forward looking, look to its function as insurance. Okay, so you've got that it's now it's becoming fair valued as insurance, and then there's this other phase that takes over after it's been fairly valued. And I was wondering whether you believe that that's mostly driven by just blind momentum players saying, oh, there's something moving up, I'm going to jump on that train, or if you think that there's this psychological anxiety that happens about, gee, if that many people think that the currency is and the treasury bonds and everything else is risky enough to jump into gold, maybe I should jump into gold too. So do you have any sense for how much, it doesn't even matter? Is it just those two come together? There's that momentum overplay, and then there's the rush to safety because others are doing it, the herd thing.
What I've observed, Dunnigan, is all of the above. Two things happen. The primary investment motivations in the world are greed and fear. Gold moves first on fear. And as the fear buyer moves the gold price up, the greed buyer steps in. The further increase in the gold price as a consequence of the greed buyer reinforces the motivation of the fear buyer, and you ricochet back between greed and fear, higher and higher and higher. It is a truism, too, that people's expectation of the future, is set by their experience in the immediate past. And what that means is that a rising price justifies the narrative around the market. So people will look at gold and they will hear that it's a medium of exchange and a store of value. They will hear that it's insurance. And all of that will be intellectually interesting until the price moves from 1,200 to 1,700. And then it will be fascinating and compelling. In other words, people will ignore the asset class when it's cheap, and they will begin to focus on it when the price action justifies in their mind the narrative. That's just the way human beings work. We regard ourselves as rational, fact-seeking machines that look for information around the world, sort the information rationally, and use it to make rational decisions. That's wrong. What we do is we look for information that supports our existing paradigms and prejudices. And there's nothing that supports a paradigm more than recent price escalation. So despite the fact that everyone should be rational, most people aren't.
Made me think when you were just describing the first part of that story, it's like another contrarian indicator is when Rick Rule is no longer considered the stodgy member, but now the fascinating conversationalist at the cocktail party. You better be ready to start selling your gold, because now everybody thinks that you're the cool guy all of a sudden.
Well, I mean, certainly the interest that I've enjoyed, I'm popular once a decade. I'm really seldom popular at cocktail parties, and generally because my range of interests is so narrow. And besides which, I'm a pretty healthy drinker. I'm pretty good competition at the bar.
We have a conversation here about silver. So we've been speaking a lot about gold, and silver is a different animal sometimes. Durfman asks, how does the fact that silver is an industrial metal keep the price of silver suppressed? I know it helps with the consumption or buying, but is there a point where it keeps silver from going higher due to the cost prohibition of the products that use it?
That's a really good question. And the honest answer is, I don't know. Now I'll try and overcome that answer. Forecasting silver supply and demand is devilishly difficult because in terms of supply, most silver doesn't come out of silver mines. It comes from either recycling or as a byproduct of precious metals and base metals, meaning that primary production doesn't impact the market as much as one would believe. Secondly, there's a major source of supply that people seldom consider, which is to say hoarders, particularly in South Asia, where people have been hoarding silver as the poor man's gold for 1,000 years and are unlikely to tell the government about sources of wealth that might not have been taxed, as an example. There are periods of time when, in particular, the rupiah declines in value against the US dollar while silver is going up, that silver escalates very rapidly in value in India. And if those times happen to coincide with a poor harvest, as an example, a need for cash in rural India, silver comes out from under the mattress and surprises everybody on the supply side. Similarly, on the demand side, the ability of the citizenry, the common citizenry in Pakistan, Bangladesh, India, and Sri Lanka to store their wealth in silver during periods of time when those economies are performing well is an astonishing silver sink. I mean, truly an astonishing silver sink. What we see right now in terms of industrial markets is that industrial markets for everything worldwide are in decline. And that includes, as an example, solar panels, which are a primary industrial user of silver, particularly in China. So we're seeing very weak industrial demand right now, which might account for some of the weakness in the silver price.
And how do you translate that into going forward? What people have very different views of forecasting what they believe is a most likely path forward for our economy, economic activity, raw material consumption, that sort of thing. You look a lot at the natural resource space. What are you thinking going forward as far as the likelihood of demand materializing for silver, for example?
The scenario that I envision, which doesn't mean that scenario is going to occur, is that the policy response that the big thinkers of the world have put in place to an economic slowdown, which is to say quantitative easing and artificially low interest rates, will stimulate demand for all precious metals. In my experience, gold moves first. In my experience, observing 8 prior precious metals bull markets in my career, after gold has established the pattern, silver moves. But silver moves further. It's a more volatile material. It attracts both fear buyers and speculators, and it's available to a broader audience because of its lower unit cost. It doesn't mean that just because it's happened 8 times before, it has to happen again. But my expectation is if the gold move is of the magnitude that I think it may be, that the silver move, while it will occur later, will be dramatic. I would tell your readers to take care of their insurance before they take care of their speculation. And if they care about my stacking advice or my physical advice, do the gold first. Save your family. Worry about getting rich later. And if you have money left over, look at the most volatile of all asset classes, which we've talked about before, the silver stocks, but only after you've taken care of the first 2 categories.
This gets back to what you've been talking about, the profligate money printing by the Federal Reserve and so on. John Beasley says, in the short term, next year or so, do you see deflation or rapid inflation or something else?
I see us sort of threading the needle between both, unless there is another black swan that hits the market. Assuming that we go through the next 12 to 18 months without a major credit crisis, that is to say, if we get through without a sort of a 2008 style circumstances where the banks don't trust each other, I suspect that the deflationary forces, which would in a free market be the predominant forces right now, would clash with the inflationary forces, which is to say the debasement of the currency. And that we will go along in a circumstance not unlike the circumstance that we're in right now. If we do not blow the system up in the next 12 to 18 months, which is to say, if we don't have a real crisis in confidence that's at least temporarily bigger than the Fed's and the big thinkers' ability to stick handle our way out of. The ultimate response, I suspect, will be good old-fashioned 1970s style stagflation. Not a pretty circumstance, a place where the purchasing power of your savings denominated in traditional instruments declines relative to the basket of goods and services that you buy at the same time that the economy is stuck. Now, I want to say, probably to the relief of everyone listening here, that I'm a credit analyst. I'm not an economist, and so I'm making all of this up. But in response to the question I was asked, those are my best guesses.
Thank you for that. We've got a question back on the effect of major players in the metals markets. Sum Ting Wong says, with Scotiabank pulling out of metals, being one of the top 10 shorters, how long do you think it will take to unwind their short position? And being the second large bank to exit metals, what estimated time frame for the remaining banks to exit?
That's a great question. And the first part of the answer is I don't know. I don't think that Scotiabank exited the metals business because of a short position or even out of any factor associated with the metals business. I think that they exited the metals business because the management team that they had at Scotia Makata misread the market and didn't do a good job maintaining firm profitability. I think the second reason that they exited the metals business is that we've had a contraction in credit worldwide. And Scotia Makata was a business that operated on credit. It was an extremely leveraged business. And when that credit became unavailable, either through third parties or on the bank's balance sheet, when the cost of capital associated with metals trading operations ran up compared to the cost of credit in leveraged debt operations, the business became uneconomic for Scotiabank, and Scotia exited it. I don't think that Scotia's exit had anything to do with a short position. I think the short position had to do with their metals business. One of the things I've learned is that most of us assume that the big banks are run by brilliant, big thinkers, people who have the ability to see 10 years and 20 years ahead. I've learned that that's wrong. These are often people that, had they not come from good families and graduated from good schools, would be working at 7-Elevens. And the truth is that they assume that the market in the future will be precisely the same as the market that they've enjoyed in the past. And I think that the short position had to do with the fact that the price narrative in precious metals over the last 20 years has basically been down. So their assumption was more of the same. Well, it turned out that they weren't merely wrong, they were very wrong. At the same time that the cost of being wrong, which is to say the cost of credit, and in particular the relative cost of credit, the cost of credit associated with precious metals trading operations relative to the cost of credit associated with trading sovereign bonds, became unacceptably high.
Interesting. So we've got a question here. Actually, there's about a dozen questions, so I'm just going to ask it as a quote unquote melding of all of these. But Great. People are asking for Sprott. The reason we have you on is not only because of your experience and awareness and knowledge, but it's also because you're connected with a particularly reputable fund, that a company that has funds that can allow people or enable people to participate in precious metals and other resources. So they're asking, and what should they consider? Are any of the funds that Sprott offers potential alternatives to people or augments to people who already hold physical metals, that sort of thing?
Yes. Now, what I'm going to say next is not intended and should not be considered individual investment advice. We have a range of investment products in our physical precious metals trusts. At last count, about $7 billion worth of assets in those products, held on behalf of about 220,000 investors, where we are entrusted with investors' money. These products trade on the New York Stock Exchange, and we trade any inbound purchases, net inbound purchases, and we buy physical precious metals with it. We store those precious metals in the Royal Canadian Mint. For certain investors, this is a great way to hold physical precious metals. In fact, I myself, I've been a long time holder of physical precious metals. In my declining years, I would prefer to own the Sprott products, first of all, because I trust us. Secondly, because these are very low cost, very low fee alternatives. They trade on the New York Stock Exchange, so depending on what your commission is, free at some firms, the transaction costs are extremely, extremely low, and they're very convenient. I can buy them and sell them with the click of a mouse. For me, the most important attribute, frankly, as a high-income U.S. taxpayer, is that the trusts are taxed at the capital gains rate rather than physical precious metals or their ETF surrogates, which are taxed at the collectibles rate. Which means that if I'm right about the direction of precious metals and at some time I sell part of my hoard and I make a capital gain, I will pay less in tax on that gain that I made. So depending on the individual and that individual's tax status, particularly in the U.S., we believe that our physical products are absolute best-in-breed products. That being said, every investor's circumstance is different, and we would want to visit with the investor to determine whether or not that advice was relevant to that individual investor.
Two related questions that people asked. One is there a minimum amount that they would need before they could participate in that? And secondly, if they were to then liquidate at some point, is there a way to take distribution in kind, or is it simply liquidating into the market and then do what you want with your cash?
Very large investors, I think the gold minimum, if my memory serves me well, is 400 ounces, can certainly, that's gold, not silver, can certainly redeem in kind. And we've had investors redeem in kind. It's important, if you're going to redeem in kind, that you have us deliver the gold to good security storage so that the gold that's sent to you doesn't have to be reassayed for you to resell it. So it's important to have a Brinks account or some other kind of account. I'm sure through Miles Franklin as an example that you could help people do that. But it's usually much more advantageous merely to sell it on market and, in fact, grab the cash. That is a much more suitable transaction for most people. The benefit to individual investors, smaller investors, to have the redemption feature in place means that we never traded big discounts to net asset value, because if we do, the arbitrageurs come in, they short the gold, they buy the unit, they surrender the unit for redemption and cover the short with the gold. Now, as to minimums, the minimum will really depend on the minimum at the brokerage house that you have an account at. There are places like Schwab or Fidelity which will allow you to buy $200 or $300 worth of those exchange-traded products. The normal minimum to open up an account with us, with Sprott Global, is $50,000 US. And for $50,000 US, we can assist you in establishing a much, much, much broader investment account, should you wish, including physical gold, gold stocks, all kinds of assets. But in answer to the question, the normal minimum to open an account with Sprott Global is $50,000 US.
But to participate in those funds, you can just purchase them through your regular brokerage, it sounds like.
Absolutely. It's through any brokerage that you feel like, any discounter, any regular brokerage firm, and whatever their minimum is the minimum that's required.
So anybody who feels like we belabor that topic, I merged a whole bunch of questions into those, so there you go. So now this last one's kind of fun. David Day asks a two-part question, if you'd be kind enough to indulge. If you had your time to live over again, one, if you had to pick the same industry for your career to end up back where you are now, would you have taken a different route to get there?
In truth, I would have. In truth, had I reimagined my life, and by the way, my life has been superb. I have no regrets. I've had a tremendously good time. I'm tremendously happy. I'm ludicrously lucky. But since you asked the question, if I had my career to do all over again, I would have gone in the insurance business. I'm fascinated with the subject of risk, and I would love to use my capital twice. Once, as I do now, to invest, and again, using my capital as collateral to assume risks on behalf of other people. I'm fascinated with risk. I'm fascinated with the insurance business, which I'm in now, in addition to being in this business. And I love the idea that I can utilize my capital to benefit society and myself twice. It turns out that assuming risk in the insurance business is very much an investment process, trying to determine what the net present value of the risk is and what the probability of the event is relative to what you're paid to assume the risk. And while you wait for the claim, the inevitable claim, you invest the premiums. But the most absurd part of the insurance business, and I learned this by reading Warren Buffett's annual reports, is that if you're not a big spender, if you're trying to get rich as opposed to live rich, and you don't take what you're allowed to do in the insurance business is you are allowed to establish policy loss reserves, which exceed by a substantial margin your actual policy losses. And if you don't salary or dividend those reserves, you are allowed to build them up and reinvest them without tax. So intelligent insurance investors become prior taxpayers. I love the concept of being a prior taxpayer. One thing that I've noticed in 45 years of investing is that money compounds much, much, much faster, tax-free.
When you don't have someone hanging on your coattails? Yeah.
In answer to the question, my life has been great. I have no complaints. If I had it to do all over again, I would have gone in the insurance business.
I think you just answered the second part of the question I didn't get to, which is if you went into a completely different career. Well, maybe this isn't. Yeah, maybe this is a different one. If you went into a completely different career, what would it have been?
Oh, well, my initial career aspiration as a very young man was to be a field biologist, probably a herpetologist. My stepfather was the chairman of the Department of Biology at an American university. And after he explained to me how much biologists got paid and what sort of abuse they had to take from their masters, usually the government, I was disabused of that career aspiration when I was about 13. But if money had nothing to do with it, and if I didn't bridle so much at authority, I probably would have chosen to be either a biologist or a geologist. I would have done something involved in earth sciences or biology, which fascinate me.
You must take opportunity at a time when you're doing field visits or whatever, looking at mining prospects or whatever, to get your hands a little bit dirty with the geology aspect. But do you ever go birding? You said you like to take nature hikes.
I do, and I also live here in Southern California on a large bird refuge. And I can sit on my own deck, and I have 3 resident ospreys on my property. They joust on occasion with peregrine falcons. I have all variety of other birds, including 2 endangered species that I'd prefer not to talk about because the government might keep me from weeding my yard or something like that. So I don't have to go anywhere at all to enjoy bird watching. I just go out on my own deck, which is an endless joy to me.
Well, Rick, thank you for being here and for fielding such a wide variety of questions. We've been speaking with Rick Rule, the CEO of Sprott Asset Management, and I'm going to give you a chance to re-up your offer to rank people's natural resource portfolios.
Absolutely. I think that we have given you a link that assists people in doing it more easily. If we haven't, the new address is sprottglobal.com/rankings. If you will go there and list your natural resource stocks, please, names and symbols both. I rank them all manually. I will rank I'll rank your holdings 1 through 10, 1 being best, 10 being worst, and comment on those where I think my comments might add value. I will, as I always do, include in a return email to you both the Barron's Gold Mining Index, which is a 50-year chart of relative values in the gold mining industry, which is fascinating, and also a 100-year commodity chart. And I really look forward to doing that. In fact, Dunnigan, I really want to thank you for the the wonderful conversations that I've had with your subscriber and listener base. They're a truly fascinating group of people. I enjoy being of service by helping people rank their portfolio and giving them educations. But I've had dozens of email conversations which have been both fascinating and delightful. And I want to take this opportunity to thank you for arranging that for me.
Yeah, thank you, everyone, for participating in that way. And we all learn together, and I'm no exception to that. So thank you, Rick. And thank you for joining us here for the benefit of all of our viewers.
Always a pleasure. I look forward to re-engaging at your earliest opportunity.
If you've decided that now is the right time for you to protect your family's financial future by acquiring physical precious metals, gold and silver, I'm delighted to let you know that I have now become a licensed dealer's representative for Miles Franklin, one of the oldest and most trusted names in bullion dealerships. And we can provide you with physical delivery to your personal possession or to professional vault storage or precious metals IRAs. Just email me at libertyandfinance@protonmail.com, and please include your name and phone number in your email to libertyandfinance@protonmail.com. We'll get right back with you and find out how to best meet your needs so that you can either begin or increase your acquisition of physical precious metals now and protect your family's future starting today.